Hello, Jim here. Selling options is a great way to make some extra income every month. I had one of my best days last month, September 9th. Today, I want to talk about that day. I actually rolled three positions and made over $900. I want to talk about those three trades. I'm going to share them with you at the end of the video. And I'm going to suggest why I decided to roll versus closing or letting them expire or letting them be assigned. So stay tuned. I think it's going to be well worth your while. Okay, before we jump into the specifics for the video, I do want to give a quick market update. Employment numbers look better than expected on Friday. Also, the Eastern port workers have decided to pause the strike until January, which may be kind of a bad thing for the beginning of next year. But short term, I do think it kind of will calm the market a little bit. It doesn't mean we're done with a lot of volatility. I do believe that people need to stay safe through October and through the election. I think the Fed's probably only going to do a quarter point cut in November and then probably another quarter point in December, or they may not do any kind of cuts depending on, how employment, how the economy looks, what inflation looks like. So at least that's my 2 cents. And as always, it's probably only worth 2 cents. So I probably roll more trades than anything else. So this video will be talking about the three trades I've made. I'm going to share them with you at the very end of this video, but I just kind of wanted to share how I look at rolling and how it can be so impactful and you can make such good money with it. So there's some criteria I like to use for rolling. First of all, when I'm looking at a position and it's getting ready to expire or it's potentially deep in the money, I like to go back and look. I like to see, has anything changed with the company? Is it still doing well? Has it still got a good handle on productivity and debt? Has management changed? Has the CEO left? I'll dig a little bit deeper and see, has anything changed? Do I still want to own this company? Because that is so critical, picking companies that you want to own at the right prices. And that at the right prices is also very critical. Has the stock dropped so much that I no longer want to own it or something? A lot of times I've looked at when a stock has dropped and I've found out, well, I might have rolled out of a good scenario. I might have rolled out of a situation where I could have owned that stock for a great price. So it's kind of a double-edged sword. You don't, whenever a stock drops significantly, you're kind of inclined not to want it, but it may be at that point in time that may be your best choice. So again, review the stock or the ETF. Has anything changed? Then I like to look at, how deep in the money is it? If it's still fairly far away from expiration and it's what I like to call not more than 10% in the money. I've looked at many of my trades and I've noticed that some of them that are deeper in the money are the ones that are typically assigned, and it's typically or usually 10% or more. So if it's a $100 stock, it reaches a $90 value. And if it goes below that $90 value, then I need to be very concerned that it's going to be assigned early. And I have to kind of give it more of an emphasis on managing. In my planning worksheet that I share with my memberships, and as always, you can find out details about my memberships in the description. I typically in my planning worksheet will note those with a background of a dark yellow. I use a lighter yellow if it's less than 10% because I've had a lot of positions that will go in the money and come back out. And by being patient, a lot of my positions might have gone in the money and then come out and then they just expire or I close them. There have been some instances where they have been assigned, but again, I've looked and I still like the company and it's still worth owning and I've allowed assignment. And in some of those cases, or most of those cases, it's worked out really well for me. A couple of instances have not, like Big Lots and Lumen Technologies. Those two, they went south big time. I think Big Lots recently went bankrupt too. Lumen is coming back, 2 years after the fact, it is coming back. And I kept 100 shares just so I could remember what I went through and how I made the mistake of not looking at their debt. And they had so much debt that it should have been kind of a cautionary tale for me to stay away from them because they had way too much debt. And then what I like to do is I like to see, can I close them for cheap? I like to close positions at about 80% profitable. So say I made $100 on that contract, can I close it for $20 or less? And if I can, a lot of times I will close, because I have found if you close now and then open a new position later when the market's down, you can typically do better. Of course, rolling is simply closing your current position and opening a new one, and hopefully getting a better strike at that time, as well as bringing in more income. A lot of times if I'm still happy with the stock and I still like its price, I'll just kind of roll with the same strikes, and I can make a lot of income. Again, you'll see it at the end of this video where I share with you how much I made on each of these trades. And then I also like to look at the total return calculation. So, if it's a stock that's not a major grower, it's a Walmart, you may see it, grow 4, 5, 8% on a yearly basis. But if I roll it, I can make a significant return on it. Then that's also an important consideration. I typically like to make $100 or more per contract when I roll. And I like to usually get, a pretty good return with that. Typically, I like to get over 100% return. So if you're looking at it on a yearly basis, it's almost like the capital you have at risk, it's almost like doubling it. Some people say, well, you should triple it or get like over 300 or 350. But I'm a firm believer, I'd rather make a lot of singles and doubles than home runs and grand slams. It's just the way I like to trade. I don't like to take a huge amount of risk, and I'd rather have a lot of little winners than, one potential trade that could go way against me. So, and then time frame for rolling. Sometimes, I try to roll most of my positions just out another month. So again, it can generate monthly income. But sometimes I've found that if I go out 2 months, especially in the case of cash secured puts, you can bring in a ton of cash. I mean, it can be significant. Again, you're going to see that at the end of this video when I share the actual trades. So one thing I wanted to also mention is I have accounts both at Schwab and Fidelity, and rolling and managing your trades are pretty much the same in both places. Schwab does a little bit of a better job. If you're using even their old-fashioned portal, you can still roll spreads, and if you're going to roll an iron condor or something that's got multiple wings, then you can roll each wing. So the functionality and the features is very easy to use. Typically, you can right-click on the position itself, and one of the choices is roll. It makes it really easy to do. Fidelity is a little bit more complicated. If you're using their portal, you can roll cash secured puts, you can roll covered calls, but anything with more than one leg, like a spread or an iron condor, you can't easily manage that. Now, if you use their Active Trader Pro, you can roll spreads, and that's what I do. Usually one of the first things I do in the morning is open up Active Trader Pro and just go through any of my positions that are expiring soon and just see if there's any really good premium. All I do is click roll. The screen populates for you, and you can actually see right off the bat, wow, this is bringing in over $100 or over $125. I need to dig a little bit deeper. Now, if you have to break apart a trade, for instance, something's going to be assigned to you, but you want it to be assigned to you, but you want to also sell the puts, then you have to make a phone call to Fidelity, and they'll work with you. They'll actually break the trade apart, and then you can trade the individual legs. Now, you can do that on Schwab, and you don't have to have anything broken apart. But I just wanted to mention that most of my members use either Schwab, which includes Thinkorswim. I have not used Thinkorswim a whole lot. I plan to use it going forward. So some future videos will probably have it in there. But Fidelity definitely has some limitations. But in my humble opinion, it's well worth it with the extra interest that you earn on the cash dedicated to puts. It's been pretty substantial for me. So that being said, let's jump into the next part of the video where I'll share with you the actual trades. So stay tuned. Okay, here's the spreadsheet. This is my planning worksheet. I just removed the other trades. I made a copy of it, and I just have the 3 trades I want to talk about today, which all occurred on September 9th, which you can see here. The first one is Qualcomm. Again, I like to turn over and look to see, well, Qualcomm was in the money. Was it deep in the money? At the time it was 160.70. My short strike was 150. My long was 140. So it was still $10 out of the money. So I was less concerned about it being in the money and potentially being assigned to me. But that did not keep me from checking it to see if I could bring in some pretty good cash. I originally set up this trade on 8-1. So this I believe was the first roll with it. Originally it was expiring on September 20th. And it was again at 160.77 at the time. I believe now it's even higher. And I rolled it just literally out a month, same strikes. And I brought in 224 in additional premium, which my required capital is 1775. So it's 2,000 minus the 224.53 because this is a vertical put credit spread. And the return is like 118%, which again is in that area that I like. And next is Zoom. Zoom is one of those stocks that for the longest time, it just seemed like it was going down and down and down. At the time I made this trade back in March, it was in the money. I mean, I can even show you what it looked like if I go here to Zoom. And you can actually see it kept hitting lower lows. It kept kind of drifting down and down and down. And I kept telling people they have such good numbers. They have no debt. They're just producing cash that they will get a bounce. And sure enough, earnings came in higher than expected. And they've been kind of trending sideways, again, going down. They tend to go down and have a big bounce and then go down. But you can see they have a pretty low PE at 12.83, which for technology companies is significantly low. And if you come over, at the time I looked at profitability, they have good profitability. I looked at growth. They have okay growth, not the greatest. They have really good income growth. They don't currently pay a dividend, but if you look at earnings, they usually beat earnings by quite a bit. Their year-over-year earnings isn't the best, but it's also based on what their actuals were. So they've always seemed to kind of project lower, but then, beat by a significant amount. So it's turned out to be a good company. So for them, at the time, they were pretty near in the money, and it was expiring 9/20, 65.55. I've probably done more trades with Zoom. I don't know, maybe 40 or 50 trades over the last couple of years. I used to just do 55.45 or 60.50 vertical put credit spreads. For the longest time, none ever got assigned. I believe I do own 200 shares now. But it just was a cash producer for me. And it used to still got pretty good premium, but at one time it had much better premium, why that's important is things change. So it may not have as good premium now, but that could very well change in the near future. And that's one of the things that you don't really learn until you start trading options quite a bit. Its premium can be really good for a company for some period of time, and then it can change and it's not as good. So just keep that in mind. But I rolled it again, kept to the same strikes, went out to 11, 15, 24. So I went out a little bit farther because again, the premium was a little bit less. And I brought in 255.74. The required capital was 1744.26, and that's like an 80% return. So not quite as good, but did bring in more cash. And part of the reason is I just went farther out. So I went out to November versus October, and I still have this position. It's pretty profitable now. I might end up being able to close it completely. The next one is ASO. This is Academy Sports. So let's look at them too, just out of curiosity, because they were definitely in the money when I rolled them. And I like Academy Sports. This is where I shop. And you can see they've been trending down quite a bit. Now they've kind of had a bump upwards. So I still own them or still have this position. It's still in the money slightly. We can look at profitability, good but not great, but I do like the return on common equity. They have good return on assets. Not quite at that 10. I like 13 and above, but 10 is good. And I like the return on common equity to be close to 30 or higher. So their profitability looks good, their growth. This is a little deceptive because they are opening new stores and they have quite a few new stores projected to be opening in the next year. So their growth could again kind of rebound and go up even more versus a C. Earnings, you can see it's been kind of a mixed bag. They kind of, the next 2 quarters, they are going to kind of have a rough time. Then they're going to have a major bounce back. And you can see they're going to be doing a lot better by, what is that? First quarter 26? Yeah, first quarter. So, which I believe the way they do their earnings, I think that's like second quarter next year or something along those lines. So a good company, I'm fine if I get assigned, but I went ahead and rolled because it's a cash secured put. It was 57.50. So right now, even still, it's right close to the money. It kind of comes in and out of the money quite a bit. I did two contracts, cash secured put at 57.50. It was originally expiring on 9/20. It was 53.58. So it was deeper in the money when I did the roll. And I did go a little bit farther out. I went to 117.25. And I brought in a lot of cash. You'll notice I brought in $427 in cash. So that's almost like a over $2 impact per share. So if it got assigned to me, it's almost like instead of 47.50, it would be like 45 in the sense. But again, I've rolled them a number of times. I've rolled them where I brought in total premium of $1,481, almost $1,500, which is like $750. So again, if they were assigned to me now, it'd be like owning them at $50. And then long term, and I've had a lot of other companies like Academy Sports that, 5 years down the road, they're worth 2 or 3 times what they are today, or twice what they are today. So they have good returns and they grow nicely over the years. So I currently don't own any. I wouldn't mind owning them. So the required capital, that's the 57.50 minus the 427. And then it's like almost an 11% yearly return, which again is really good when you look at it from a cash secured put standpoint. It's based on the full value of the 57.50 per share. So could I get that kind of a return on a yearly basis? And not even a yearly basis. Well, that would be a yearly basis. It would be difficult to a company like Academy Sports. So I decided at that point it was worth it. I will take a lower yearly return for a cash secured put than I will a vertical put credit spread. But again, it's right at that level. It very well could expire come January, or I may roll it again for even more cash. So, and those 3 trades, again, I did them all on that day, and with rolling, especially rolling to the same in all cases for all 3 of these companies, I rolled them to the same strikes. It was relatively simple. I did it quickly, maybe spent an hour, and probably half that time was writing it out for my membership, explaining why I want to do this versus letting assignment, defining exactly why I made the choice that I made. If I didn't have to do that, I probably could have made these trades in 20 minutes, 15 minutes. And I have a lot of members in the community that are probably doing a lot more trades than I am, and probably doing better than I am. I know a few are, which is nice because I like to look at their trades. I like to look at what they're doing and kind of learn from them. So that's what I wanted to share with you guys. So a few trades can make a huge difference, and it's not a whole lot of work. With me still working, I can do this with a minimal amount of time. So let me know what you think. Have you made some trades like this? Do you like to roll? Are you more of a trader than an investor? I look at myself as an investor with trading options. It's kind of extra icing on the cake. Are you also an investor and just trying to earn some extra icing on the cake? Let me know what works for you, and how do you deal with managing the trades? So as always, thanks for taking the time to watch the video, and look forward to you joining me next time. Thank you.